Hello and welcome everyone to this launch event to celebrate the publication of the Brighteye European Edtech Funding Report 2025. My name is Hege and I'm head of community at Brighteye. I'm not here to do most of the talking. Our founding partner Ben Vers and head of platform and research Reese Spence will take you through the updates on our fund and some of the key findings of the report this afternoon. So with that, I am happy to hand over to Ben to start the presentation.
Great, thanks again. And welcome everyone. Thanks for joining us. So Alex Latsis and I founded Brighteye back in 2017 to invest in early stage technology companies across Europe that help people learn and grow. I think that probably our second year in existence did our first funding report and have been sort of chronicling the growth of EdTech in Europe specifically, the growth in the funding pattern ever since. We believe that tech-driven businesses that empower people to develop professionally, academically, and personally can have exponential trajectories and produce dramatic returns for customers, founders, and investors alike. That's the belief that we had before we started the fund, and it's only been reinforced as by our investments in companies like Educate, Ornicar, Hack the Box, One Day, and at this point we have 50 companies in our portfolio. Some of whom have grown 20 to 50x since our initial investment. Ornicar announced today actually that they've reached 100 million revenue threshold and are profitable in their education business, even as they scale up in insurance. So it's great to see that kind of sort of scale being reached in EdTech in Europe. That said, the field of EdTech has evolved a great deal, as has our thesis. We're about to get into that. And if I'm honest, while the pandemic from 2019 through, 2020 through 2022 prompted a groundswell of adoption of digital learning tools, the ensuing retrenchment, as usage fell post-pandemic, combined with volatility in the labor market and mass adoption of AI, has overall in 2023 and 2022 and 2023 slowed demand for venture capital investment in EdTech. Ironically, this came at a time when the return on learning is higher than it's ever been, and the technologies themselves are more promising. Employers are desperate for high-skilled talent to take advantage of a lot of the technologies that are advancing on kind of what seems like a daily basis. And individuals with those skills are well rewarded. So the incentive to actually learn new things is higher than it's ever been. Same software combining guided active learning with automation of routine tasks have brought learning and productivity much closer. And so the ROI for learning technologies is actually higher now than it's been in the past. And similarly, learning, job placement, and college talent management are so we'll talk about how those changes have evolved at the field of EdTech and our own thesis. So, as I said, we started Brighteye really investing with learning at the core of our thesis. We believe that, honestly, the big change at the 10,000-foot view is that the place where learning is happening is no longer purely in training platforms or in formal educational settings. It's now the place where learning is happening now happens kind of in the process of finding a job, and also increasingly on the job, and that those learning experiences are just as important and valuable. And so we've expanded our thesis to kind of across that value chain of learning to include companies that are using technology not just to unlock new learning experiences, but to unlock new ways for people to make use of the skills that they gain. So professional advancement, and also to once they have a new sort of position, to make use of to learn on the job and combine productivity and learning in a variety of ways. I guess we can talk about that on the next slide. I think the way that the rubric that we've used to define kind of EdTech, this sort of broader definition of EdTech, is investing in companies that help people learn, work, and thrive. And we break that down in really kind of three buckets. So companies that help people to acquire skills, so training, and that means either platforms where they can acquire knowledge directly, or platforms that help existing learning institutions to become more efficient. First bucket, and I think that honestly, if you look at historically, that was 90% plus of what we invested in, and that's still a big piece of what we're doing going forward. Yeah, you can look at companies in our portfolio that sort of meet that rubric. You know, it's a huge market, and I think it will continue to be a big market going forward. I think if we flip to the next slide, we are increasingly focused on companies like Educate, like Shakers, like others, like Car, which are essentially labor marketplaces that allow people to make use of the skills. Sorry, I'm getting there's a note that said that you guys can't hear me very well. So hold on one second. Let me see if I can change my speakers.
Okay, is that any better? Can you guys hear me okay or no? Yeah. Okay. Apologies for that. Thanks for the feedback. Okay, yeah, so the second bucket is essentially technology that help people to find work in various ways, either through labor marketplaces or through kind of skills management, recruitment software. Here are a couple of examples of companies that we've invested in the space. And then if you flip to the last slide, the final bucket is what we call enhanced, so technology that combines learning and productivity. That includes all kinds of co-pilots and technologies that automates feedback and allows you to get more done at the same time, as well as learning agencies. So the idea of taking a class and 6 months ago and hoping that you remember the information in that class when it's useful for you, no longer has to be the case. You can have a class that you take, and then actually that class can follow you around, so that information is available to you when you need it in various circumstances. And so those three buckets of training, placement, and enhancement are kind of the scope of EdTech 2.0. It's the scope of sort of interesting opportunities that we see. And I guess before, not to steal any thunder from Reese, but the important thing to realize is that while EdTech 2.0, or sorry, EdTech 1.0, so the classic definition of EdTech, funding for that has grown, the scope of funding for this broader universe of companies that are impacting learning, placement, and productivity is much larger. And so as companies expand across that spectrum, we expect their funding sort of opportunities to expand as well. So that's it. I'll stop talking in terms of sort of the general change that we're seeing in the field, and I'll let Reese dive into some of the specific funding trends that we saw.
Cool, thanks, Ben. No problem about stealing any thunder. There's plenty of thunder to go around, hopefully. So we can dive in now. Just to give everyone a bit of a heads up very quickly on how we structured the report this year, we basically had the challenge of needing to include the evolved thesis and the data behind that within the report. And so we basically have a part one, which runs through the conventional understanding. We then introduce this new updated and evolving thesis, and then we look at the data within that area. And then, of course, there's a couple of separate sections on exits at the end. One thing we will be doing is, because we've obviously only looked at this data for this EdTech 2.0 area for 2024, we're going to start backdating that in the next couple of weeks, so we have a better understanding of how that market has evolved as well. But without further ado, jumping into some of the headlines. As Ben mentioned, really positive to see a relatively positive expansion of funding between 23 and 24. I'd say this was somewhat unexpected within sort of conventional EdTech circles. I think people's broad understanding of how EdTech was doing was that momentum was slowing. So we were very pleasantly surprised to see that, as we've written there, green shoots of an upswing appear to be in play. But a lot of that was driven largely by the US, in the same way as sort of the downswing between 22 and 23 was driven by falls in US funding or falls in US deal activity. I think the pickup between 23 and 24 was largely US driven, and I think it appears to be the case that Europe broadly follows the US. And so despite sort of, as we'll go on to see, sort of funding slowing within Europe in 2024, we can expect a relatively strong uptick in activity into this year, which is also evidenced by the fact that funding within Europe in Q4 was significantly higher, almost double than any of the other previous quarters. So momentum's heading in the right direction. And also quite positive for the longer term health of the ecosystem, or at least the medium and then hopefully longer term health of the ecosystem globally, was the increase in activity that we saw in terms of number of deals done between 1 and 15 million within those two round categories that we've created, which are largely there to reflect the size of rounds that we see at seed broadly and at Series A. And so, yeah, that was relatively positive, somewhat unexpected again, but a really healthy indicator of activity. And one thing that I don't think I mentioned was that it was really promising also to see a significant increase in the number of deals done in 2024 relative to 2023. And obviously some of that is reflected in this round size data here. So in 2024, there was 1,153 deals done in global EdTech, and that's up from, I think, 915 in 2023. So quite a marked increase, and hopefully something that's here to stay. And again, to reiterate, this is within the conventional EdTech definition that we've been using for a number of years. Of course, very pleased to see Brighteye having a relatively prominent role on this slide. Reach, of course, out there in front, but I think one of the other headlines for us was, of course, the presence of funds like General Catalyst, Sequoia, and Excel within the top 10. Obviously, they're the kind of funds that we'd love to have a very genuine interest in education and EdTech. It's obviously a good indicator of the health of the ecosystem if those generalist investors are choosing to invest some of their valuable capital into the sector. So that was again sort of something we were very pleased to see, and something that I would say has sort of returned in the past year, that perhaps had a slightly fallow period in 23 and 22. Cool. Moving into Europe now. So as we've referenced, funding fell overall. We do believe that this is reflecting largely sort of the dynamics that we've seen in the US, i.e. we're probably about half a year behind the US when it comes to sort of the trends that we see. And so as I referenced, we hope to see a significant uptick in activity maintained from Q4 24 into Q1 25 and onwards. Deal count stayed relatively stable, which again is relatively positive. And I think when you look at the largest 10 deals done in Europe, there are no sort of real outliers there that have sort of had a outsized impact on the macro figures that we've had in previous years. So, when Go Student was raising 200 to 300 million, it was completely sort of obscuring sort of what the sort of larger picture might look like from a total funding perspective. Whereas this year you can see sort of quite considerable activity in those sort of 10 to sort of 50 million range. And you can see two companies there highlighted in blue, which are Brighteye companies, which are both incidentally working in the K-12 space, which is traditionally known as one that's slightly more challenging to grow a successful business in those areas. So it's obviously really pleasing to see those two present within the top 6. And also, of course, we're pleased to see them there because we like them very much. And then if you look at the activity between different geographies, the headline from this slide is really, I guess, the slowing advantage of the UK relative to other markets, and then also the presence of Sweden and Italy for the first time. which is again sort of partially reflective of the fact that the fifth place nation by funding raised was slightly lower than it has been in previous years, but also it is genuinely reflecting a significant uptick in activity within Italy. So yeah, they're the two sort of headlines from this slide, I would say. Now, shifting into the updated thesis stuff that Ben introduced at the start. The market sizing is, of course, is substantially bigger within EdTech 2.0, within that sort of broadened learning, working, thriving definition that we're starting to look at now from an investment perspective. And when you look at the VC funding raised in 2024, EdTech 1.0 reflects 6.3 billion, and EdTech 2.0 is more in the field of 15.4 billion. And so naturally, the same active markets and same in terms of deal count, but also in terms of most capital raised, it's exactly where you kind of expect it to be. It reflects the conventional EdTech activity that we'd have seen elsewhere, but of course now that sort of pond of potential interesting EdTech companies and learning companies is substantially bigger. And of course, naturally, we're very pleased to see, a lot of activity in the earlier stages under this new definition. And so you can see there, YC, Antler, Techstars, Elevate Ventures, and Sequoia are the 5 most active investors under that banner. The observations we've made there, all very much early stage focused funds. They are also, there's also a number of accelerators within that list, but also in the longer list of the top 20 that we looked at quite closely. They all tend to have global interest. And then also they seem to be indicative of sectors with momentum. And so, of course, it's nice for us to see that there are lots of EdTech companies, learning companies operating or being funded and supported and backed by these top organizations. And of course, Sequoia sort of seems to be involved in everything. So it's quite hard to see exactly to what extent Sequoia's interest in EdTech 2.0 as a thing is sort of genuine and here to stay, because of course they're so active in other sectors as well. But of course, we're pleased to see them there. And then in terms of sort of the distribution of round sizes, again, very indicative indicators of a healthy ecosystem. So the observations we've got here is relatively balanced across the 5 stages, far more balanced than it is if you're looking within conventional EdTech, where it's far more dominant in the early stage rounds than it is in this chart. The other thing to observe, I think, is the significant deal density in the bottom 2 categories. So it's over 1,500 deals there, which is about 3 times as many as there are across all the other categories. So yeah, about 3 times as much activity in terms of deal count for deals under 4 million relative to those over 4 million. We thought to include some of the top deals globally under this new banner for us. You can see them on screen, so I won't run through all of them in great detail, but you can see that those largest round sizes are significantly above those that we observed within sort of the conventional EdTech 1.0. You can also start to see some of those top funds invested in the right-hand column. So I'll probably leave that one there, but feel free to dive into it. And then I'll dive into the final section of this, which is activity within Europe, within the EdTech 2.0 banner. Rather than sort of the 15 billion you see at the global level, it's just under 2 billion within Europe. The UK is sort of back to its sort of usual ascendant position within this list. But I think one thing that is very positive in terms of the health of the ecosystem within EdTech 2.0 is the presence of 9 markets within the top 10 cities by deal activity. So the only market, interestingly, that has 2 cities represented on this list is Spain, and all the others are, of course, they're the cities you'd reference if you had to put forward a list. But I think one of the things that's very helpful for us and very positive for us as a European fund with interest right across the continent is, of course, the level of activity in some of these major tech hubs. And of course, we'll look to do a lot more in each of these places for the rest of the year and beyond. So you'll hopefully start to see us in Amsterdam, more of a presence in Stockholm, and we've just been doing a few things in Italy, in Milan as well. So yeah, that I made it sound like we're sort of working up the list, but I think that's partially because we've got a presence already in sort of the top three there, and some of the others as well. Final slide. Actually, penultimate slide, is on exit activity. There were well, I guess that there was a surprising level of exit activity, I'd say, in 2024. We looked at some of the data for exits in Q1 to Q3 2024. There were 93 transactions. This is all within Europe, by the way. But within this slide, we decided to pull out some of the interesting examples at the global level, but also at the European level. There's a little bit of analysis around some of the key deals within the report here. But I guess, you know, some of these really made the headlines. So PowerSchool being taken private by Bain, Udacity's acquisition, by Accenture, which is a very interesting case because, of course, a global consulting business choosing to bring a lot of the workforce training content under their banner, so that they can then, you know, incorporate that within the service offerings that they have in place. Of course, it reflects the fact that they're obviously becoming more and more involved in designing L&D programs and designing sort of workforce support programs within companies that they're consulting on, which is intriguing and interesting, I guess, because Accenture's sort of previously been seen as obviously a more tech savvy, but still relatively analog consultancy. So seeing them acquire an Edtech company to try and boost that profile it was sort of a relatively interesting deal to see. The final slide, which I've actually mainly included because I thought it was really interesting, and I can't take credit for this because Ben did the analysis, but it's super cool. Basically, looking at the average headcounts of different acquired companies, and this isn't the kind of the data I've seen before. So super interesting insights that tell you sort of the typical headcounts for deals of acquired companies, whether they're PE sponsored, say private equity sponsored, or whether they're acquired by companies and then primarily for integration within the acquiring company. So you can see particular density within PE sponsored deals from 0 to 100 employees, and then they obviously fall quite significantly afterwards, probably because those companies become quite expensive. And then if you're looking at the acquired companies that don't include sort of a private equity sponsorship, you see a similar trend in terms of density of deals from 0 to 100, but then slightly more sort of robust number of deals in the 100 to 500 range of headcount. And so that is basically a very quick overview of the report. We did pull together some predictions, so I'm not going to read them all now, but you can sort of read them very quickly on the screen. Some of them more obvious than others, some of them related to verticals and some of them related to deal activity. But then just to sort of show you the final two, I sort of promised I won't read them out, but there you go. Gives you a good sense of where we're looking. And I guess one other thing to highlight is that, as ever, we have a very active sort of content program ongoing at the moment, and we'll be looking at a lot of these areas in a lot more detail. So we'll be getting under the skin of some of these predictions quite meaningfully, including a couple of pieces of work that we will be published in February, which is part of a campaign we're running looking at the use of AI in corporate environments, with 3 publications on the use of AI in hiring, in training, and then in enhancing productivity. And you can hopefully see how that ties back to Ben's presentation. And so that's probably quite a good point to end for symmetry purposes. So there you go. I'll stop. I'll move it. Oh, there you go. There's the headlines. I forgot that slide, but there you go. If you're wondering how we were thinking of the top 5, that's what they are. So I'll hand back to Hege now, and thanks for listening.
That's amazing. Thank you so much, Reese, and Ben, of course, for the quick but very, very good run through. I'm just going to wrap up. Just mention, like as Reese said, we do a lot of content, or he does a lot, most of it, that can be found on the Brighteye website under the tab that's called Sidekick, everything we have published so far and everything we are publishing in the future will be possible to find there. So that's just a heads up for the new Sidekick content hub that we've quite recently launched. Other than that, follow us on social media, LinkedIn mainly, and keep an eye out for all the new content.